On October 24th, 1907, the entire United States financial system came within hours of total collapse. Banks were closing their doors. Trust companies were failing overnight. Panicked crowds were lined up around city blocks trying to pull out their life savings before it was too late. And in the middle of all of it, one 30-year-old trader made more money in a single day than most people would earn in 10 lifetimes by betting that everything would fall apart. His name was Jesse Livermore, and by the end of that one trading day, he had made the equivalent of over $3 million worth well over $100 million today, while an entire nation watched its financial system come apart at the seams. Here's the part that should stop you in your tracks. Livermore didn't get lucky. He didn't guess. He saw this collapse coming weeks in advance, using nothing but price patterns on a ticker tape. No news alerts, no economic data releases, no Federal Reserve because it didn't even exist yet. In this episode, we're going to break down exactly how he called it, the specific signals he was watching, the position he built, and the almost unbelievable moment when the most powerful banker in America personally asked him to stop trading because he was making the crisis worse. Welcome back to the Livermore Ledger. This is episode 2. To understand what Jesse Livermore saw coming, you first need to understand what the market looked like in the years leading up to 1907. The early 1900s were a period of massive, uncontrolled speculation. There was no Securities and Exchange Commission. There was no Federal Reserve to act as a lender of last resort. Banks and trust companies operated with almost no regulatory oversight, lending out far more money than they had in actual reserves. It was a financial system built on confidence, and confidence, as Livermore already understood better than almost anyone, is the single most fragile thing in any market. By 1906, Livermore had already rebuilt his fortune after his humbling loss in New York. He had learned the hard lesson about slippage and timing that we covered in episode 1, and he had refined his approach. He wasn't just reading individual stock patterns anymore, he was starting to read the market as a whole, watching how groups of stocks moved together, and more importantly, watching how they moved right before major shifts. In the spring of 1906, Livermore noticed something odd. Railroad stocks, which were the backbone of the American economy at the time, essentially the technology stocks of their era, were behaving strangely. They would rally on good news, but the rallies were weaker than they should have been. They would sell off on bad news, and the sell-offs were sharper and faster than the fundamentals seemed to justify. To most traders, this would have looked like normal market noise. To Livermore, it looked like something else entirely. Exhaustion. The market was telling him, through its price action, that the enormous bull run of the early 1900s was running out of buyers. Livermore began building what he called a short line, a series of short positions across multiple railroad and industrial stocks, betting that their prices would fall. This wasn't a single bold prediction. It was methodical, built position by position, as the pattern confirmed itself again and again. Here's what made Livermore different from the average speculator of his era, and honestly from most traders today. He wasn't attached to being right. Each time he opened a short position, he watched closely to see if the market agreed with him. If a stock moved against his position, he closed it quickly and took a small loss. If the market confirmed his read, he added to the position. This is the origin of one of his most famous principles, the idea that you should never argue with the tape. The market doesn't care about your opinion. It only cares about what it's actually doing. Through late 1906 and into 1907, Livermore steadily built his short positions. San Francisco was hit by a devastating earthquake in April 1906, and the resulting insurance payouts drained enormous amounts of gold out of American banks to cover claims. This was the first real crack in the system's foundation. Capital was leaving the country at a moment when the banking system had almost no reserve cushion to absorb the loss. By early 1907, the signs were everywhere for anyone willing to look. Interest rates were climbing as banks scrambled for capital. Stock prices, especially in the railroad sector, were becoming increasingly volatile, with sharp drops that failed to fully recover. Livermore later described this period as watching a building with cracks spreading slowly across its foundation. You don't know exactly when it will collapse, but you know with growing certainty that it will. The final trigger came in October of 1907, and it started with an attempted stock manipulation scheme that had nothing directly to do with Livermore at all. A group of speculators attempted to corner the market on shares of the United Copper Company. The scheme failed spectacularly, and in the process, it revealed that several major trust companies, essentially unregulated banks that held enormous deposits, had been financing the scheme with depositor money. When word got out, panic spread almost instantly. Depositors rushed to pull their money out of the Knickerbocker Trust Company, one of the largest trust companies in New York. Within hours, the Knickerbocker had run out of cash and was forced to close its doors. This is what's known as a bank run, and in 1907, with no federal deposit insurance and no central bank to step in, a bank run could genuinely bring down the entire financial system. The panic spread from the Knickerbocker to other trust companies within days. Stock prices collapsed. Credit froze completely. Businesses couldn't borrow money to make payroll, and banks refused to lend to each other out of pure fear. The New York Stock Exchange itself came dangerously close to having to shut down entirely due to a complete absence of available capital to settle trades. This was the exact moment Livermore had been positioning for. His short positions, built patiently over the previous 18 months, were now paying off at a staggering rate. As stock prices collapsed across the board, the value of his short bets skyrocketed. On the single worst day of the panic, October 24th, 1907, Livermore's profits were so large that his own broker reportedly had to check with the firm's partners to confirm they could actually cover the payout. Here's the part of this story that sounds almost too dramatic to be true, but it's well documented in Livermore's own later accounts. At the height of the panic, the legendary banker, J.P. Morgan personally organized a coalition of the country's wealthiest financiers to pool their own money and rescue the collapsing banking system, essentially acting as a one-man central bank, since none existed at the time. Morgan worked around the clock, locking bank presidents in his personal library until they agreed to contribute funds to shore up the system. But there was a problem. Even as Morgan poured money into the system to stop the bleeding, aggressive short sellers in the stock market were continuing to hammer prices downward, threatening to undo his rescue efforts entirely. And the most successful, most aggressive short seller in the entire market was Jesse Livermore. According to Livermore's own later account, a representative acting on behalf of Morgan's coalition reached out to him directly during the height of the crisis with an unusual request: stop shorting the market. Not because he was doing anything illegal, he wasn't, but because his selling pressure was actively working against the coalition's efforts to stabilize prices and prevent total collapse. Livermore, by his own account, agreed. He stopped adding to his short positions and began covering them, buying back his short bets, which had the secondary effect of actually helping stabilize prices further. He didn't do this out of pure civic duty. He also recognized, with the same tape-reading instinct that had made him rich, that the bottom was likely near. Continuing to press his advantage risked being caught in a sharp reversal once Morgan's rescue effort took hold. This decision reveals something crucial about Livermore that goes beyond just his technical skill. He understood, at least in this moment, that being right about a trade and knowing when to stop are two entirely different skills. He had the discipline, in this specific case, to recognize the edge of the opportunity and step back from it. Let's break down what actually happened here, because the historical drama can obscure some genuinely useful lessons for anyone trading markets today. Lesson 1. Patterns build before headlines do. Livermore didn't have access to economic data releases or financial news alerts. He built his entire short position based purely on price behavior, weakening rallies, sharpening sell-offs, and structural cracks like the gold drain following the San Francisco earthquake. By the time the Knickerbocker Trust collapse made headlines, the market had already been signaling distress for over a year. This is a principle that holds up remarkably well today. By the time something is major news, the market has usually already been pricing in the underlying stress for weeks or months beforehand. Lesson 2. Conviction should be built incrementally, not declared all at once. Livermore didn't wake up one day and bet everything on a market collapse. He built his short line position by position, testing the market's reaction each step of the way and only adding size when the pattern confirmed itself. This is the opposite of how most retail traders operate today, where an idea leads to an immediately oversized position with no room for the market to prove the thesis wrong. Lesson 3. And this might be the most underappreciated part of the entire story. Knowing when to stop is its own skill, separate from knowing when to start. Livermore had every incentive to keep pressing his short position as the panic deepened. The money kept flowing in the more he pushed. But he recognized that continuing past a certain point shifted him from reading the market to fighting a coordinated effort by the most powerful financial coalition in the country. That's a distinction most traders never learn to make, and it's part of why so many spectacular winning trades eventually turn into spectacular losing ones. The panic of 1907 didn't just make Livermore an enormous fortune, it also cemented his reputation, and not entirely in a good way. The press dubbed him the Great Bear of Wall Street, and public sentiment toward him was genuinely hostile. Newspapers ran stories blaming short sellers, Livermore specifically included, for deepening the suffering of ordinary Americans who had lost savings, jobs, and businesses in the panic. This is worth sitting with for a moment, because it highlights an uncomfortable truth about markets that remains true today. The trader who correctly identifies and profits from a coming collapse is often viewed as the villain of the story. Even though he didn't cause the underlying weakness, he simply read it more clearly and faster than everyone else. The panic of 1907 also had a lasting historical impact far beyond Livermore's personal fortune. The near-total collapse of the banking system, and the fact that it took one private citizen, J.P. Morgan, to personally organize a rescue effort, exposed how dangerously fragile the American financial system actually was without any central regulatory authority. This crisis became one of the primary catalysts for the eventual creation of the Federal Reserve System in 1913, specifically designed to prevent private individuals from ever again being solely responsible for stabilizing the nation's banks. In other words, the very crisis that made Jesse Livermore one of the richest men in America also helped reshape the entire structure of the American financial system for the next century. Here's what I want you to take away from the panic of 1907. Beyond the historical drama of a bank run and a young trader making a fortune off other people's fear, Livermore's edge wasn't secret information. It wasn't insider access. It was patient, methodical observation of price behavior, combined with the discipline to build a position slowly and the wisdom to recognize when the opportunity had reached its natural limit. Those two things, patience in building conviction and discipline in knowing when to stop, are exactly the two things most traders today still struggle with more than a century later. If Episode 1 taught us that knowing the rules isn't the same as following them, Episode 2 adds the next layer. Even when you are following your rules perfectly, there's a moment where continuing to press an advantage stops being trading and starts being something else entirely. Livermore recognized that line in 1907. He wouldn't always recognize it in the years that followed, and we'll get into exactly how that same skill failed him later in his career in a future episode. If this breakdown helped you see market panics differently, hit subscribe, because next episode we're covering the moment Livermore's discipline failed him, the reckless overconfidence that came after this very trade, and how it set the stage for one of the biggest losses of his career. Drop a comment. Do you think Livermore was right to stop shorting when Morgan's people asked him to, or should he have kept pressing his edge? I'll be reading through the responses for next week's video. This has been the Livermore Ledger. The tape doesn't lie. The question is whether you're patient enough to read it. I'll see you in the next one.